It's a pretty easy way to make money if you follow some simple rules.
It is called the fear index. When VIX jumps, many investors get scared. But for option sellers, there are also many opportunities in a high VIX. My guest today will explain his strategy of shorting the VIX. Welcome to Kevin Kwan.
Thanks, John. Nice to be here.
So tell me, Kevin, why is shorting the VIX a good strategy?
Shorting VIX is, well, okay, let me just start by saying that VIX is mean reverting. So most of the time, it's going to exist somewhere between a certain level, and it's very predictable that it's going to fall after it spikes. So if you see VIX, up in 40 and 50, it's going to at some point fall back down to below 20. It's just how VIX works. It's very mean reverting. So I wanted to take advantage of high VIX and just profit off the higher volatility by shorting it. So you have to look out for when VIX goes high and then short. It's not something I would continually do throughout the year. It's only when VIX is high. It's a strategy focuses on hunting for opportunities versus, let's say, I'm shorting a put on XSP or something like that, which I can do throughout the year. So it goes well with other strategies as an opportunity-based strategy.
And we will for sure dig into this. But tell me first a little bit about yourself, both as an option trader and as a person.
Sure. So I've been trading stocks since about 2016. And I started tinkering with options around 2017. I all started with Robinhood. I didn't get into Tasty Trade or really get into shorting options until 2018 when I really started learning about it. So I've got a decent amount of experience with trading options by now.
Where do you live and what do you do when you are not trading options?
So I live in SF Bay Area. For work, I do finance for commercial real estate properties, and free time, I do like fish keeping. I do like barbecues, and I've got a whole lot of other hobbies.
For those of us not from California, SF means San Francisco, I guess.
That's right.
So let's start with the basic question. What is VIX?
So VIX is, generally speaking, is the fear gauge. It measures amount of volatility in a 30-day SPX option. So they just look at all the put and call options at the 30-day expiration for SPX, and it's basically the implied volatility at the 30-day mark.
So it's some kind of a measure of how much we can expect the market to move in the next month.
Correct. It's a measure of how scared mostly institutional investors are of the market. So they buy more puts to hedge their positions. That causes the prices of puts to go up, and it causes the implied volatility to go up, and so that's reflected in the VIX at the 30-day expiration.
And you short the VIX as a strategy that you sometimes use. Explain a bit more in detail why you do that.
Yeah, so I keep VIX on my watch list and I have notifications. My phone just gets notifications whenever it goes above a certain level, whether it's 20, 30, and 40. And then I know it's time to short. So I just see it as an opportunity that just comes up whenever something happens in the market, say whether it's tariffs or COVID. It's a pretty easy way to make money if you follow some simple rules. It's not complicated. It's something that I can sleep well at night. If I short VIX, sell it. If I sell a call on VIX at say 80 to 90, I can sleep pretty well at night and not worry about big losses. I like strategies that are simple and not complicated. If I can, my measurement of a good strategy is if I can sleep well at night and I can manage my emotions pretty well, it's a good strategy, right? So that's kind of my whole rationale for selling options to begin with. Is I do like the slow burn strategies, something that I can just reasonably work out well with time. Because I think the key to really day trading really comes down to managing emotions, and part of managing emotions is going strategies that you can comfortably sleep well at night with. So that's why I short VIX. It just goes well with my philosophy on trading.
You pointed out that the VIX tend to mean revert. So maybe it will be useful to look at a couple of the time periods where the VIX has been really high.
Sure.
We could go back to, I guess, 2008 during the
I think that's a
financial
great
crisis.
example. Yeah.
What do you
Yes.
read out of this graph?
You can see around October of 2008. That's when VIX really began to spike. Highest it ever went to was like not even 90, and it didn't stay there for more than a day. It just touched it and then moved back down. So you can just see it just sort of fall pretty quickly between October of 2008 and then December, 2 months later it's fallen back down to 40. So you can reasonably expect VIX to just return to quickly just slingshot back down to the ground if it goes up really high. So the great thing about the strategy is if you give yourself some room to double down on shorting VIX, you'll make some money, you know, quite a bit of money. And the higher up it goes, the more profitable it gets to short. I have spoken with other individuals who would short VIX as well, and they wait for VIX to go up even higher than I would before they begin shorting it. But it's a very profitable strategy from shorting really high up because it's going to contract really quickly. I mean, 2, 3 months, if you short it at around 60, 70, you're going to make quite a bit of money. And it's always mean reverting. It's eventually going to go back down to 20. It's just a matter of time. And given how 2008 was one of the worst crises, the fact that it went back down from its highs in about 2 months is pretty incredible.
And I guess another time when VIX went really high was at the start of the pandemic.
Yeah. And VIX contracted even faster during 2020. So it hit a high of 85. Again, it didn't really stay there for more than 1 or 2 days before it went back below 80. And then if you look from essentially March of 2020 to April, it fell back down from 80s to low 40s. High VIX just doesn't last very long. These are some of the worst crises that we've faced in modern times. It just contracts really quickly. So it's one way to take advantage of some external factors that cause a lot of fear in the markets and make some money.
It sounds very easy, Kevin. Just short it when it reaches a certain level. But the market is not always predictable. So maybe we should dig into a bit more in detail to how you actually do it and what you read out of the different VIX levels.
VIX essentially goes from zero and it can go up really high above. It's a scale that sort of measures volatility, as I mentioned earlier, on 30-day SPX options. It has never hit 100 before. It's a scale that goes from zero to technically infinity, but it's really hard for it to climb up there, climb up close to 100 and stay there. So, for example, if SPX S&P 500 falls by like 1% or something, and VIX is currently at 16, it might go up to 18 or even 19. But in order for it to hit 20 or more, it's got to fall more than 1% in a given day. S&P 500 has to fall faster and harder in order for VIX to go up higher, and that's because it needs to scare investors a lot. If you see VIX at like 50, it's going to be pretty hard for it to climb up higher because S&P 500 needs to fall harder in order to create more fear in the market. It's very predictable. These levels are generally pretty good predictions of fear in the market, and at some point it's going to max out. So between 0 to 11, I've never I don't I've never seen VIX fall that low before. Usually persists between 12 and 19. So 0 to 11 I think is just excessively greedy in a very, very bullish market. 12 to 19 is where VIX usually ends up at in a normal bull market. 12 is still pretty low. I think it's going to be around 15 to 17 most of the time, but 12 and 19, there's nothing to really do here because that's just an indication of a normal market. But once it starts hit like 20 to 30, this is sort of pullback territory, I'd call it. I'd begin to short VIX around 40. I sell my short strike at 40 and buy a long call at 100 or maybe 90. But the key thing here is you don't want to put all your eggs into one basket. And what I mean is you don't want to start shorting all of your capital at once just because it hits 20. And that was a mistake I made during this tariff situation was I did not listen to my own rules, which was you would only sell about at most 5% of your capital if VIX is between 20 to 30. For me, that would have been about 5 spreads maybe a little bit more. I really should not have sold. I went way more than I should have in terms of capital. So around end of February, beginning of March, I ended up selling 22 spreads. Again, I was only supposed to sell 5. 22 spreads expiring beginning of April. And, come April, VIX just shot up from like 20s to 40s and 50s. And I'm like, oh, well, I've got 4 days left to expiration and VIX is at 50s. So I had to close them out for a loss. That was my fault. So really, my point in mentioning this is the plan works. You just have to stick with the rules. And one of the biggest rules is not putting too much of your capital when VIX is at 20 to 30, right? Because you need to make room for when VIX does spike up. If I followed my own rules, I'd be up about $5,000-$6,000 by now. And I wouldn't be in that hole. So 20 30s, start shorting VIX at a short strike of 40, but don't go all in. I wouldn't go more than 5% of my capital. At VIX 40 to 50, the news starts to mention more and more about recessions every single time VIX climbs up closer to 40, and this was true in the past crisis, the past tariff crisis too, is you could literally just see as VIX just got into the 40s, people started mentioning the word recession all over the place, left and right. So when it hits 40 and 50, you can start selling spreads, and I wouldn't do more than another 5%. You can start selling spreads as far back as 90 strike. It's okay to do 80, 90, even a little bit 70, but 90 is a pretty safe level. One of the things that I would have done if I could go back in time, besides not overcommitting all my capital when VIX hit 20, 30, and this is if you have portfolio margin. What I would have done was if I sold four spreads at 40, 100, I would roll that short call at 40 further back in time and keep those 4 positions naked and just start selling new spreads of between 70 to 90. That's what I would have done. But because I overcommitted by selling 22 spreads, I had to close a bunch out for a loss. So that's one thing I would do. But if you don't have portfolio margin, simply closing it out for a loss or rolling it out is fine, because you'll make up more of that profit by just selling additional spreads at a higher strike on the VIX, which is something you can do as soon as it hits 40 to 50. So yeah, at 40, 50, you can sell more spreads around 90 strike. You can go below that. Just use some judgment and just look for whatever credit looks good. One thing I did notice for a very brief amount of time was that there's not a whole lot of theta decay when VIX goes up really high. And it was between the 7, 14, and 30-day VIX, there wasn't a huge difference in premium in the bid and ask. One thing I extrapolated from that was that the market must be expecting VIX to contract really quickly in less than 30 days. The premium between the different expirations was not that much different. And the market was right. In less than 30 days, we saw VIX contract from like mid 50s all the way back down to 30s and 20s. So yeah, I would sell short strikes at as high as you can, around 40, 50s for as long as you can. It's going to contract pretty quickly. 60 to 70, once VIX hits 60 to 70, I would start to go all in. I would commit another 10% of available capital for as far out of the money as you can. And 80 to 90, same thing.
You are obviously doing call spreads, but
Yeah.
what are the more specific mechanics, and like how many days to expiration are you looking at, etc.?
Yeah, so I'm selling it across different expirations. I like to sell when VIX is at 20 to 30, I'd sell between 30 days and 60 days. I wouldn't sell as many during the 30 days, because the thing about VIX is it can contract pretty quickly, but it can stay around 30s to 40s for quite a while. So I would sell it between 30 to 60 days with an expiration, 30 to maybe 70 days an expiration. And the higher up it goes, I want to take advantage of the higher VIX by keeping as much premium as I can. So I would sell it pretty far out of the money, or pretty far out in terms of expiration. I'd sell it at 60 days or longer if I can. Go for the monthly expirations. They just have more liquidity than the weeklies. 20, 30 VIX, 40, sell the 40 VIX spread between 30 to 70 days. And if it's higher up, I'd sell expirations as 60 days or longer just to take advantage of that premium.
But you're running with pretty widespread. What is your rules for getting out of losses? Do you run it by stop loss?
I don't use stop losses. I mean, the notional value of VIX is pretty small compared to SPX, so I don't bother with stop losses. And if VIX goes up pretty quickly, you can see the bid and ask widen considerably. So I wouldn't bother with that, to be honest, especially since VIX is such a small index to begin with. Because between 40 to 100, you're looking at a notional value of like $6,000. That's not very big at all in terms of spread. I have portfolio margins, so I could go naked and just assume that, the highest it would go is 100 realistically. And the margin requirement just isn't that high. And the losses to me are not that big of a deal. So, I mean, with this tariff crisis, even though I had to close out a bunch of VIX spreads at a loss, I only lost $7,000. It's not a big amount relative to my portfolio. It's pretty insignificant. So I don't bother with stop losses on the VIX, especially since it's a spread and the fact that VIX is already a small index. I would just close it out for a loss at 40s. If you sell a short spread at like 70 to 100, your notionals want $3,000, right? So I don't really bother with stop losses with something that small.
I guess it would depend on your account size,
It
though.
would, like all strategies, it would depend on your account size. At 70, I would just go naked.
You make the point that VIX will always mean revert, but
Correct.
you could also say that VIX will also sometimes spike. You can expect it to spike. So I
You can,
guess a
yeah.
safer alternative trade is to buy the calls when the VIX is low.
You can do that, yeah. The thing about calls is timing is everything, right? It will spike, but I have no idea when it will spike, but I know when it will go back. I know that after it spikes, it's going to come back down pretty quickly in a couple months. It's that lack of predictability of when VIX will spike is the reason why I personally avoid buying calls because most of the time it's pretty mean reverting, right? So it's going to go back down, but I don't know when it's going to spike. That lack of predictability is why I don't go long on the VIX unless it's really, really low. We're talking about like below 12, which I've never seen.
You explain that this is for you a supplemental strategy that you do when opportunities arise, and of course, VIX is not always spiking, thanks God.
Yeah.
Uh, but if I ask you to put this way of trading and this strategy on a risk scale, from 1 being very low risk and 10 being very high risk, where would you put it?
That's a great question. I would put it somewhere around 4 to 5. And there's a couple of reasons. 4 to 5, because one, it's fairly predictable. It's going to come back down. It always does. And two, VIX is not, in terms of notional values, it's a very small, I feel like it's an appropriate trade for small traders because VIX is a pretty small index overall. And if you put a spread on it, it's only a couple $1,000s or several $1,000s, depending on how wide your spreads are. You can even get away with selling spreads as narrow as 40, 60. So you're really only spending a notional value of $2,000. It is technically a defined risk trade. You can control how much you want to risk in that trade. And then because it's predictable, it's small, I would consider it a low risk trade. So that's why I would put it on 4 or 5 compared with other strategies that I do.
Talking about that, what are your main strategies?
Generally speaking, I like to go long on the index and pick individual stocks to short via selling front ratio calls. So I sell puts on XSP. I keep rolling XSP puts. So I have about 6 XSP puts across different expirations that I continuously roll. And currently they're in the money, and that's fine. I have the buying power to keep rolling them over and collecting some credits, even if they are in the money. So one way I can boost my profits is just by shorting VIX when VIX goes up and XSP goes in the money. My overall strategy is to go along the index and pick individual stocks to short.
Let's sum up this strategy of shorting the VIX. How would you sum it up? Who is it suited for?
I would sum it up as if you have some extra buying power in your account that you can spend on, I would say it's great even for small accounts if you keep some buying power on the side because you're not going to have this trade happen all the time. It's very seasonal. And like I said, it's very opportunity based. So you're not going to see an opportunity to short VIX every single week. I do keep a lot of buying power on the side. My main account, I've got portfolio margins, so I do have that spare buying power. And also my IRA, which I trade a lot with on Tasty Trade. I have a lot of cash, so I start shorting VIX on my IRA as well. And since it's a defined risk trade, it's a credit spread, it is legal within those IRA rules. You don't need margin to trade VIX. So because it's a pretty small trade and I consider it pretty safe, I feel like it's pretty appropriate for small accounts as well.
Where is a good place to learn more about this?
That's a great question. I don't have any specific books in particular. There's a lot of I personally learned a lot from just continuously watching VIX all the time and just reading about it on Tasty Trade. So Tasty Trade, they have a lot of good information about VIX.
Mm.
And really, a lot of this is kind of public information. The strategy that I'm putting up shorting VIX isn't very proprietary. A lot of the stuff I'm saying is just kind of general knowledge. So if you just do your due diligence on Google, I feel like you can find a lot of good information. Really, I mean, if you learn the fundamentals of how credit spreads work, I think that would be really helpful. But yeah, I credit a lot of the information that I got from early on in 2018 from Tasty Trade, Investopedia. There's some other resources too that I can't think off the top of my head, but Tasty Trade really has a huge amount of information. I wouldn't do every single trade they do, but they offer some pretty good information for you to develop your own strategies. And I think learning the fundamentals from Tasty Trade really helped me out.
I will, of course, also recommend people to watch the weekly interviews we do here on Theta Profits. Every Sunday, we publish a new interview with a retail trader or an options trading expert on a lot of different topics. So check them out, and maybe you'll find something that is interesting for you. Kevin, thank you very much for sharing your strategy and for joining in on this interview.
Thank you, John. Appreciate it.